Good morning. Welcome to the investment meeting of the Teachers Retirement Board for February 6, 2025. I'll start by calling the roll. Nadia Fazolina. Present. Thomas Brown.
Good morning, President.
Karina Apollo. Gregory Faulkner. All right. John Dorser.
Present.
Victoria Lee.
Good morning, present.
Christina McGrath.
Good morning, present.
We have a quorum. I'll turn it over to the chair.
Great, thank you, Patricia. Good morning, everybody. And we'll start this morning's meeting with Goldman Sachs and the Passport Fund's December 2024 performance review.
Thanks, Tom.
Thank you, Amanda.
I think Gina from my team is pulling up the December flash report. And for the month of December, we did have negative returns across the board for the variable funds. You can see in that first column of returns in the flash, although all modestly negative, anywhere from about 1% to 3% range for the variable funds. We did, as kind of a market backdrop, we did see the Fed cutting interest rates by another 25 basis points in the December meeting. So ending the year down 1% from where we were in terms of highs for interest rates earlier in the year, but we also did have the Fed come out with more hawkish comments around more gradual pace for cuts from here on out. So in terms of markets, we did, of course, have a bit of a drop at the end of December, a little bit of negative markets, but overall, like I said, modestly negative results for the month. If we look out for the calendar year, for the variable funds, you see positive results across the board for each of the variable funds, although a little bit of a mix in terms of relative results. The diversified equity fund, where the bulk of your assets sit in the passport funds, was up over 18% when we look at the full calendar year. The strongest component of that return coming from the passive US equity exposure, a little bit of weaker results from the international sleeve, which only was up around 3.5% for the calendar year. Looking down the page, would also highlight the sustainable equity fund, which was one of your strongest absolute performers on the year, was up over 20% for calendar year 24. But did not keep pace with its benchmark. And that's pretty typical for what we saw last year. It was a difficult time for active managers in general, and particularly in this large cap growth space. That Russell 1000 growth benchmark that the Sustainable Equity Fund benchmarks itself against was really one of the toughest benchmarks to beat, and was very much dominated by those big high flying growth stocks that have dominated equity markets. So overall, a strong year for the variable funds, and we ended the year at around 21.2 billion in total assets for the variable funds.
Thank you, Amanda. Good questions. Amanda, great. Yeah, we'll move on to the January 2025 market performance update.
Yeah, so as you all know, we don't yet have results for the funds themselves, but we do have a benchmark report to use as proxy for the passport funds here. And thankfully for the month of January, we saw a bit of a bounce back from the negative results in December in pretty similar scales. So in December, most of your funds were down around 3%. For the month of January, up around 3% for most of those funds, the balanced fund being up around 1.3% in January. And of course, towards the end of January, we did see a couple of blips, particularly around the noise around DeepSeek and what that might mean for stocks like NVIDIA and others that are playing in this AI space. And also the disruption around what's going to be happening with tariffs with different countries and trading partners that has carried through here into February. So despite a little bit of noise at the end of the month, we did land in positive territory across asset classes here for January.
That's good. Great, thank you, Amanda. Any questions for Amanda? Great, and then we move on to the public agenda pension fund market commentary. I guess Steve, will take it away.
Thank you, Mr. Chair.
Thank you.
Great, just to echo a lot of what Amanda's already said, I'll be very succinct this morning. On the first slide, Tom. Just a quick look at, well, three things, the economy as a backdrop to the markets, and then finally your performance. So the economy is actually in quite good shape. You can look here on the upper left-hand side, you can see real GDP for the fourth quarter came in at 2.5%, above trend, trends usually around 2%, maybe 2.1%. So solid growth, inflation was below that. You can see US inflation, CPI for December year over year, just 2.9%. But it's trended down. It's actually up a little bit from where it had been previously. Inflation's proven to be stickier, I'd say, than the Fed likes. And Amanda's absolutely correct that we had a rate cut in December, but hawkish sentiment that there'll be probably a while until a little more. The market right now is pricing between 1 and 2 additional 25 basis point rate cuts by the end of 2025. The employment picture is actually quite strong as well. If you look on the upper right-hand side, the unemployment rate as it stood in December is 4.1%. We have a new non-farm payroll report and unemployment report tomorrow morning at 8:30. For December, non-farm payrolls were expected to come in at 165,000 jobs created. It actually came in at 256,000 jobs created. Consensus estimate for tomorrow is 4.1% unemployment and another 170,000 jobs created in the month of January. We'll see how that pans out. And finally, on the lower right-hand side, world currencies. The US dollar is pretty much strong across the board, evidenced by the other currencies showing up in red relative to the US dollar. This is all relative to the US dollar. So again, strong dollar has to do with a number of things. The growth rate is quite good in the States. There's a perception that we have a new administration will be perhaps more pro-growth, which is attracting more capital into the U.S. markets. And again, just the positive capital flows associated with that. On the next slide, a quick look at rates. On the upper left-hand side, you can see where we've been over the last year. Rates, as Amanda reflected, came down in the U.S. Official interest rates 100 basis points. The Bank of England actually cut rates another 25 basis points just this morning, which means that their change over the last year is down 75 basis points. And the Bank of Japan at the bottom there is really an outlier. They actually just raised rates again in January. So their official rates are now 50 basis points. And again, 60 basis points. That's coming off of where they were a year ago at a negative 10 basis points. They had negative rates for a prolonged period of time. And this is the first rate hiking cycle since the global financial crisis. So a differentiated outcome there. The slide below that, there's the chart below that, US Treasury yield curve. The red top is the most recent. And it shows that we really had mostly a disinversion of the yield curve, meaning that longer rates are now typically longer than short rates. You'd expect to get more a maturity premium as you invest out the curve. The fact that red bar, that red line is above the orange bar also reflects that US Treasury yields have moved up and bond price is low. It's been a little bit painful to get there, but the income component of your fixed income investments is now more significant, which is a benefit. On the upper right-hand side, you can see we have investment grade credit spreads and high yield credit spreads. They've actually come in quite a bit. I don't know that they're necessarily compelling now. A lot of this has to do with the fact that we've had strong growth, relatively low defaults. But for example, in high yield, and you can see on the far right-hand side, the change is a decline of 70 basis points in high yield spreads. And the spread is basically what you get on an equivalent US dollar treasury with the same duration, plus, in this instance today, 260 basis points of additional spread. And finally, below that, you can see how the yield curve is changing. So 2-year yields are basically where they were a year ago. They're at 420. They were at 420 this morning. They were at 421 a yield a year ago. But we have seen a backup in longer term rates for a number of reasons. US Treasury 10-year sovereigns have actually moved up 63 basis points. Higher yields mean lower bond prices. Again, a little bit painful to get there, but you now have carry and income associated with your fixed income investments that is very positive. The last note I'd make, last comment I'd make on this slide is the 30-year fixed mortgage rates. It's still at 7%, still relatively high. That has to do with the backup in US Treasury yields. Obviously, I don't think that's a great picture for housing. And that's why existing home and new home sales have been down. There's a lot less activity in turnover in housing right now because the mortgage rates are relatively high. On the next slide, a quick just look year to date where we are in stocks and bonds. Here's the good news, and I think Amanda touched on this as well in her January update. Stock prices are up pretty much across the board with a couple of exceptions towards the bottom in Asia. But that's just year to date. You see the percent change year to date and the percent change in currency differentials year to date. That's what those two green lines on the left are showing you, those columns. So a good outcome so far for stocks, although it's very early, it's only one month's worth of performance. And on the right-hand side, those are 10-year sovereign yields. Most of those numbers to the far right, the year-to-date change are negative. That means that yields have come down, bond prices have gone up. So a positive thing for portfolios as well. Now to the substance of the conversation. Next slide, a quick look at your performance over different periods of time. And you can see here that your performance in 1 month for December was actually mostly negative in public markets. Amanda talked about the fact that the markets had sold off and were a little bit more volatile. Typically, you'd expect to see a Santa Claus rally in December and see more green, but we didn't have that this year. Most importantly, I think you need to look at, say, 10 years to look at the long-term average annual returns per asset class. And at the very bottom, your total plan returns for the 10-year period average 7%, which is your benchmark return target. And you can see, obviously, we've had differences in terms of performance. So U.S. equities on average over the last 10 years have returned 12.6%. And those are your U.S. equity investments, your portfolio performance. Remember that the average of the 5 general consultants, the average 10-year return assumption for U.S. equities is just 6.7%. So I just caution you not to expect 12.6% going forward. It should come down. If I had to guess, in the low to mid single digits perhaps this year, but that's just a guess. I think the other two takeaways are the performance on average of private equity at 13.8%, which is obviously why you invest and spend so much time in private equity. And I think we're exceptional in that area. Also infrastructure, you can see with its steady eddy. 1 year, 10.3%, 3 years, 10.5%, 11-year average annual return, 11%. And fully for 10 years, average annual returns for the infrastructure portfolio, again, under DCIO Petronicolova's watchful eye and really strong investment acumen, up 11.8% on average. So good outcomes, and we hope to continue that in the future. Any questions about anything I touched on?
Any questions for Steve? Thank you. Appreciate it. I think that wraps up our agenda for the public session. Questions? Great. Is there a motion to go into executive session?
So
Thank you. Second. And thank you, John. Any questions? All those in favor of going into executive session, please say aye. Aye. Those opposed say nay. Any abstentions? We are now in executive session. Thank you. Welcome back. We are going to have a readout from Priscilla Priscilla Bailey. Thank you. We'll have a readout.
You bet. In the executive session of the Passport Fund, there was no manager update. There was a presentation on a manager recommendation. Details will be made available at the appropriate time. In the executive session of the pension fund, there was an update on preliminary performance. There was no manager update. There was a private equity presentation. Consensus was reached. Again, details to be made available at the appropriate time. Thank you.
Thank you, Priscilla.
Thank you.
I think that concludes our business in public session. And as always, before we adjourn, I'd like to thank Will, our recorder, and Richard, our TRS tech rep. for making this meeting go smoothly. Much appreciated. And with that, I'll entertain a motion to adjourn.
So moved.
It has been moved. Thank you, John.
Second.
And thank you, Christina, for seconding it. Are there any questions? Thank you. All those in favor of adjourning this meeting, please say aye.
Aye.
And those opposed say nay. Any abstentions? I get to use this. The meeting has been adjourned. Thank you.